Today, I'm talking about my top 10 dividend stocks that I would buy and hold today for 5+ years. These are long-term dividend paying stocks. I'm gonna tell you exactly the stocks and exactly why I think they're great buys right now. Now, full disclosure, if you've seen this channel at all, I do not own these dividend stocks. I own a growth-oriented portfolio. I share every step of the way, so just watch the other videos. But I'm starting to think about dividend stocks, and here are the ones that I will be buying when I start to buy them. What I've done is I've created a dividend portfolio in Simply Safe Dividends. I've put $10,000 into each of the 10 stocks, which gets us to about a $100,000 portfolio. That $100,000 portfolio would produce $1,906 in annual income. So this is not a portfolio focused on as much income as possible. If you want to know my favorite high income paying stocks, let me know in the comments and I'll do a video on that. This is about capital appreciation and future dividend growth. And I'm gonna tell you exactly why those two things matter to me in a few minutes. The dividend yield is 1.9%. Yield on cost is 1.91%. Ignore that for now. This portfolio just started, so we'll track it over time. And as the dividends increase, this yield on cost will go up. That means what is the yield on the cost of our shares? Beta is 0.87. That just means it moves less than the market. Okay, so 100% of these dividends are considered safe according to Simply Safe Dividends. We'll get into why in this video. Dividend growth, this is key number one. I'm not worried about today's dividend yield. I'm worried about dividend growth because over time, as that dividend grows, you get paid more and more. You buy more and more shares with those dividends if you reinvest them. And it really starts to compound. Diversification of the portfolio. We have a little chunk of information technology, mostly industrials, which is a lot different than the growth stocks I own. Some healthcare and some consumer discretionary. Okay, income calendar, not really paying attention to that, but here's the income forecast. And this is where it gets interesting because of that dividend growth. So we've got $1,900 right now on a base dividend growth rate of 10% per year, which is actually less than the last 5 years. It's been 15%. So we're just going off 10%. With dividends reinvested, which gets a 2% boost because of how much the portfolio yields, and an annual contribution of $36,000 per year, which I share that I try to put $3,000 into the portfolios per month. So this is mimicking those contributions. They assume that this money yields 1.92%, which is the current dividend yield, or $690 per year, which is the current yield. So the income scenarios moving forward, if we go to that 10% per year, then in 2027, portfolio would earn $7.2 thousand in a year. 2032, it's jumped up to $16,000. 2037, $29,000, and then in just 5 years after that, it's yielding $52,000. Now, if we do a little bit better and say it does yield, we'll just go to the high end, right? Say it yields 15% per year, which is possible, but eventually that's going to come down, right? Next year, it would yield $8.4 thousand, but by the end, by 2042, which this is a stretch, right? Just to show you the difference that just 5% makes, though, in the dividend yield. By 2042, it's yielding $101,000 instead of $52,000 if it's 10%. That's why that dividend growth rate is so important, and it's important for companies to sustain it over time if you have time left that you don't need the income from the portfolio. That's how I'm thinking about it. Okay, right now I have these things in alphabetical order, and we'll just go from there. Advanced Auto Parts, currently trading at $207 a share. Ignore this part. It says this dividend yield is 445% above its 5-year average. The dividend yield is 2.9%. The PE ratio is 14.8, which is below its 5-year average. 89 dividend rating for very safe. The growth has been 50%, which is kind of crazy this year. 5-year dividend growth rate is coming in at 68%. Again, there's some weirdness in there, so don't pay attention to that. Dividend growth streak 2 years is exactly what I'm talking about. They've had some funky stuff going on because of acquisitions. Uninterrupted dividend streak 15 years. Payout ratio 37%, low for most companies. Net debt to capital 57%, and a $12 billion market cap. All right. We'll move a little faster. ABV, 141 price. It might be a little overvalued, they say, because the dividend is 17% below its 5-year average, but it's trading at almost a 4% dividend yield. Its PE ratio is 10.5, which is above its 5-year average, a 70 for dividend safety, 8.5% dividend growth over the last year, and 18% over the last 5 years. Cigna's a really interesting one to me. Currently at $2.93 a share. It might be undervalued. Again, this is a weird one just because of when they've started paying their dividend. It's showing the dividend is way high. It's got a 1.5% dividend yield. PE ratio is at 12.6, which is above its 5-year average. A 79 for dividend safety. 12% dividend growth rate in the last year, and then 151% over the last 5 years. Obviously, that's not going to be sustainable. 12% 20-year dividend growth rate, according to Simply Safe Dividends. Payout ratio is 19%, which is low for most insurers. AbbVie is 42%, which is why that rating's a little bit lower. It's edging high for biotechs. Net debt to capital for AbbVie, 81%, not meaningful due to accounting noise, they say. But then for Cigna, 39% net debt to capital is edging high for insurers. Okay, John Deere, 368. It could be overvalued because their dividend yield is 26% below its 5-year average. The yield is 1.2%, but the PE ratio is 14.2, which is below its 5-year average. The dividend safety rating is 83, 7.6% dividend growth rate in May of 2022, 9% over the last 5 years, 11% over the last 20 years, payout ratio of 22%, 28 years uninterrupted dividend streak. Edging high for equipment makers is that payout ratio. But they're moving to kind of a more recurring revenue stream, so I'm not too concerned with that. Net debt to capital, 45%, which is edging high for heavy equipment makers. They maintained their dividend from 2007 to 2009, and they did drop 65% during the 08 and 09 recession. So could be liable to a recession there. AbbVie, we didn't cover this, but it has a 50-year uninterrupted dividend streak, which is pretty impressive. Okay, Fortune Brands, FBHS. 67.46 might be undervalued because the dividend yield is 19% above its 5-year average. It has a 1.66% dividend yield. The PE ratio is 10.2, which is below its 5-year average. Dividend safety is 61, so edging to be not safe, so careful with this one. 7.7% dividend growth rate last year. 5-year dividend growth rate of 10%. 8 years dividend growth streak, and 8 years of uninterrupted dividends. The payout ratio is 19%, which is low for most companies, but their net debt to capital is 52%, which is high for most companies. So be careful with this one. Market cap, $8.95 billion. Okay, Lowe's, $211 a share. I've talked about Lowe's a lot. It's one of my favorites. Might be undervalued because the yield is 11% above its 5-year average. The dividend yield is currently 1.98%. The PE ratio is 14.8, below its 5-year average. A very safe dividend rating of 93. 31% dividend growth this year. 18% 5-year dividend growth. This is one of my favorites, I told you. 20-year dividend growth rate of 24%. 59 years of dividend growth. Uninterrupted dividend streak of 59 years. Amazing. 25% payout ratio, which is low. It's a mega cap, $137 billion. They increased their dividend during the 07 to 09 recession, but the shares dropped 52%. Okay, Parker Hannifin, $296 a share. It looks reasonably valued. The dividend yield is 6% above its 5-year average. 1.8% dividend yield. PE is 15.9, in line with its 5-year average. Dividend safety is 94, so even higher than Lowe's. 29% dividend growth this year, 11% 5-year dividend growth rate, 12% 20-year growth rate, 66 years to outdo Lowe's of dividend growth, 66 uninterrupted years of paying a dividend. Amazing. Payout ratio is 22%, which is low for most companies, very low. Net debt to capital is high for most companies, 57%. $38.6 billion market cap. They increased their dividend from 07 to 09, but shares dropped 62% in the 07 to 09 recession. All right, coming down the home stretch. Raytheon, $93.57 a share. Looks reasonably valued. 2.35% dividend yield. A 19 PE ratio, which is in line with its 5-year average. A 70 dividend safety rating. 7.8% dividend growth this year. Minus 5% over the last 5 years. 20-year dividend growth rate of 8%, and a payout ratio of 45%, which is low for most companies. Net debt to capital, 31%, which is edging high for most companies. At $139 billion market cap. They maintained their dividend from 07 to 09, but shares dropped 52% when the S&P 500 was down 55% in 07 to 09. TransDigm, they pay a special dividend, which can generally be, I think it's 8 to 10% or something like that, but it's not guaranteed every year, and they do it based off certain EBITDA metrics. But it's a incredible outperformer over the long term, which I'll share in just a minute. Taiwan Semiconductor. This one hardly ever gets undervalued, and it's currently showing overvalued based on dividend yield, but undervalued for PE. So 87.30, 1.66 dividend yield, PE ratio of 13.8, dividend safety rating of 62, minus 4% dividend growth in November 2021, 9% dividend growth over the last 5 years. Payout ratio is 36%, edging high for semiconductor firms. $446 billion market cap, so I think this is the largest one. Yep. They cut the dividend from 07 to 09, and it only went down 25% versus 55% for the S&P 500. All right, we're going to try to get through these fast in the next 2 minutes, right? We're looking for this black line to be below the blue and orange lines. The blue line is its historical PE ratio, and the orange line is basically its PE ratio times its earnings growth rate if that were to equal 1. So the price earnings growth, this orange line represents a PE of 17.7 because it's had 17% adjusted earnings growth over the period from 2001 during this time. So Advanced Auto Parts is showing as significantly undervalued, would trade up to 17% annualized return through 12/31/2024 if it just trades back up to its historical norm. Jump into AbbVie. So AbbVie also is looking a little bit undervalued out to 2024 if it trades back to its averages and hits these earnings numbers. 18% total return, 7% annual return. Not bad for a nice dividend payer, and I think it's got, like a 4% dividend yield. Cigna, it is a little bit overvalued compared to its historical norm, but still earnings growth is expected to be pretty strong. And so you're still looking at a nice 7.4% annualized return through 2024 with that 1.5% dividend growth, dividend and that nice dividend growth we talked about. Deere, all right, Deere was way overvalued, went way down, has come back up a little bit, but is now looking pretty, fairly valued with some expected earnings growth. So you're looking at a 10% annualized rate of return through 10/31/2024 if they hit these numbers. But Deere's one, it's not going anywhere. This company needs to be around for the world. Fortune Brands, okay, this one is showing as way undervalued, but this can be signs of trouble at a company, right? So do some more research on this one, but it has the most potential upside if it can get back to its normalized price to earnings ratio since 12/31/2024. I found this one on from a review on the Fast Graphs channel, so shout out to them there. Lowe's, okay, we talked about this one. So has historically traded at this blue line, right, at a PE of 19, but even if it just trades at a PE of 15 moving forward, you're looking at almost 7% annualized rate of return, which is great. Parker Hannifin, again, about fairly valued with its historical average PE of 16. So if it still trades at that through 2025, you're looking at 7% annualized return with a nice 1.77% dividend. Raytheon, looking way undervalued compared to expected earnings growth rate if compared to its normal PE ratio of 27, which could come down, so just be aware of that. But if it gets back up there, you're looking at 33% annualized return through 2024. But even to the orange line here, you're looking at a 4.5%, which is dropping down to a PE of 15 from a PE of 20. So some decent safety there considering it's a pretty solid company. Okay, TransDigm, again, their dividend, they only pay a special dividend, which comes out every once in a while. I'll do a whole video on TransDigm, but just to show you their performance, 24% annualized return, turning a $10,000 investment into $338,000 versus $10,000 in the S&P 500, turning to $36,000 since let's see, 2006. So very strong returns there. And Taiwan Semi, right? This thing hardly ever gets undervalued. It looks undervalued right now compared to historical averages, looking at a potential 25% upside. So subscribe to the channel, like the video, make sure you get these updates, and I will share my portfolio every step of the way and let you know when I start buying into these dividend stocks. Also check my email newsletter out, austin.substack.com. Link will be in the description below. Thanks for everything. Have a great weekend.